Hi, in this video we'll talk about how to account for situations where the future tax rate changes. So the question is, how are we going to account for deferred tax assets and deferred tax liabilities when we know that the tax rate will change in future years? The key is that we know it will change. So if Congress has recently passed a law that says that this tax rate will be changed effective, next year or a year and a half from now, whatever. We're not going to change our accounting method just because it's likely that the future tax rate will change or something like that. We're never going to do that. But if we know, what do we do? Because if you think about these deferred tax assets, right? If you remember from the previous video, there was that company, they had $20,000 of rent revenue, but it was only rent revenue under the tax code. It was not recognized under U.S. GAAP because they hadn't earned it yet. The tax rate was 40%, and so they had this deferred tax asset of $8,000, $20,000 times 40%. And that's because the next $20,000 they receive of rent, they would not have to pay taxes on it. So the value of that was $8,000. What happens when we know that the tax rate is actually going to be changed to 30% next year? Well, the value of that deferred tax asset is now decreased, hasn't it? If someone says you don't have to pay taxes the next $20,000 you earn, well, now that means I'm only saving $6,000, not $8,000. That's the idea. That is how we're going to account for it. Yeah, we're going to use our knowledge of future tax rates when we calculate these things. Let's do it. Paulo Roberto's 2012 depreciation for tax purposes exceeds its depreciation for book purposes by $400,000. This difference will reverse over the following years, like so. And so it's going to reverse over, looks like 5 years here. And so you're going to have deferred tax liabilities like so. Okay. See how the tax rate changes every year? So that's the answer. That's how we're going to account for it. We are going to consider what the tax rate is in every year. And I want to emphasize again, we can only do this if we know the future tax rates will be different than the current rate. A law must have been enacted. All right. So again, another example, accounting for a new tax law which changes the rates. Let's say on December 23rd, 2013, there's a new tax act signed into law that lowers the corporate tax rate from 35% down to 30%, effective January 1st, 2015. So a little over a year away. Mathis Company has a temporary difference of $3 million that will reverse equally over 2014, 15, and 16. And here's how it was going to reverse. It was going to reverse equally $1 million at a time. And so Mathis Corporation had recorded a deferred tax liability of $1,050,000. This is how they had calculated that. Now we have a new law. Now we're going to have to change this. So the new situation is, okay, it will be 35% next year, but then it'll go down to 30 and remain at 30. So the resulting DTLs are going to be a little different. You see, this DTL is different, and so is this one. And so the total is very different, huh? $100,000 less. The value of your deferred tax, or I shouldn't say value because it's a DTL. DTL is usually not a good thing. So the amount has gone down by $100,000. So what do we do? Well, we just debit deferred tax liability because it's a liability. So we're going to debit it to make it go down. And we're going to do this kind of unusual thing here. We're going to credit the income tax expense account for $100,000. Normally you would not credit an expense account, but here you will. And it probably won't end up as a credit, assuming Mathis is a profitable company. Most likely income tax expense will be offset by a debit because you're going to owe some from your operating income. All right, let's talk about net operating losses as well. This is when taxable revenues are less than your deductible expenses. If that happens, you have a net operating loss. So, okay, plain English, this is when you have a loss for tax purposes. Now, the IRS taxes you every time you make income. So it's only fair that when you lose money, they kind of share with your losses, right? I mean, it wouldn't be fair if you kept paying them taxes every year based on the income you earned, and then you lost money and they said, oh, we're not going to mess with that. That's not fair, right? So what they do, they say, okay, we're going to give you a loss carryback and a loss carry forward. You don't have to use the carryback, but you can. And you can do both. All right. Loss carryback means if I lost money this year, I get to carry it back up to 2 years in the past. If I do so, the losses must be applied to the earliest year first. All right. And I can carry it forward for 20 years. So if I lose money this year, potentially I can offset income I'm going to earn for the next 20 years. Okay. So guys, big picture here, you're going to have a deferred tax asset if you carry it forward. Okay. If you use the carry forward, you have you can have, depending on how big your loss is, you can have a very big deferred tax asset. Let's see how this works. Tommy Company has the following information for these years here. Taxable income or loss for these years and the tax rate. And so you can see the amount of taxes that Tommy Company paid. Now in 2015, Tommy Company loses $500,000. Ooh, okay. They're going to use their carryback option. And they're going to get an income tax refund, receivable, an asset, and they're going to credit benefit due to loss carryback, which is kind of like a gain account. Where do we get the $110,000? Oops, sorry about that. Where do we get the $110,000? Well, I can carry this $500,000 back up to 2 years, and I got to use the earliest year first. So say, okay, in this year I earned $100,000 times 30%. I paid $30,000 in taxes. In the next year, I paid $80,000 in taxes. So that if I add those together, I paid $110,000 in taxes the past 2 years. Now I have this big loss. I'm going to get that money back from the government. And that's what happens. And so your income statement would look like this. Operating net loss before taxes, and then benefit due to loss carryback will go in your income tax section. And so your net loss is only $390. Let's look at the carry forward then. Okay. We've used up $300,000 of the $500,000 net operating loss via carrybacks. And I hope you can see that, because of the $500,000 we lost, we offset 1 plus 2 equals $300,000 of income that we had earned the previous 2 years. So we have $200,000 of loss left, of which we can carry forward. That is worth a lot. If the tax rate is still 40%, $200,000, the next $200,000 you earn, you don't have to pay taxes on it. Okay, meaning it's worth $80,000. That's a deferred tax asset. And so we're going to have this journal entry where we say, okay, deferred tax assets go up, and we have this another credit to another gain account, benefit due to loss carry forward, which will go in your income statement in the tax section. As you can see right here. That's what it would look like if you use the carryback and the carry forward. Okay, and that's enough for this video.